said, we've done very well and we're very excited by it. I wanted to add some things because, as an investor, I wanted to put some investing tips for retail investors, which I assume most of the people listening to this are. Is, obviously the first investing tip comes from my father, which is do your own work. And even though most of it, and I got the chance to meet a lot of people from the rural group when I was at the Rural Symposium in Boca Raton. And, some of the very smartest, most diligent investors I've ever met are this group of rural people. So common sense in this industry goes a long way. What's that old thing? If it's too good to be true, it's probably not true. And in our business, unfortunately, often that's the case. But common sense goes a long way. So doing your own work, even if you're not an expert, you can learn a lot with common sense. As a retail investor, by definition, you're small and nimble. And I'm not saying this but even if you have 10 or $20 million, you can move around the markets way faster and way more nimbly than an institutional investor can. And you don't need a deal to get a position. Most institutional investors buy on deals because that's the only way they can get the size they want at the price they're trying to get. But retail investors have the liberty and the opportunity to buy when they're ready to buy, because you can buy those positions in the market. And obviously the commissions are very low, which means you can also sell easily. So my third bit of retail advice is when things start going bad, you can sell right away. If you're wrong and they seem to be getting good again, you can always buy back. The cost of buying and selling is so low that it's an advantage that you have over institutional investors. You might as well use that advantage. It's a great opportunity. And I also want to share a couple of rules of thumb, because I think these are rules of thumb that really do serve us well. And we use them every day when we're looking at things and deciding where we're going to sign a confidentiality agreement. And the first rule of thumb is with cutoff grade. Every company there, when they show you a resource, that resource has a cutoff grade. And that cutoff grade is supposed to approximate the costs. And when you're actually investing and you want to find a quality project, the actual grade should be, when you really want to find a good one, should be 3 times the cutoff grade. So when you see a gold project and the cutoff grade is 0.3, you really want to see a project that has a 0.9 or even a 1 gram head grade. That's going to be if the cutoff grade is correct, that's going to be a very robust project. And I think you want to do enough work to get comfortable that they're using the right type of cutoff grade. And same goes for underground mines. Because that cutoff grade is going to be your margin. If you have a 0.5 cutoff grade and a 1 gram head grade, you're kind of on the edge of the range, which means you're going to make a 50% margin. But if anything is wrong, your grade's a little lower, your costs are a little higher. If anything is wrong, it's going to really hurt the economics. So by having it as 3 to 1, and keep in mind your actual grade, there's going to be recoveries and other losses. You're actually going to, there's enough margin of safety in there to start you off on a good track. The other rule of thumb that we've done very well with is with regards to underground mines. And one of the problems people have done with underground mines is they try and overdevelop them. They try and run them harder than they were meant to be run. And so the lesson that I learned very early in my career, and it hasn't made me a lot, but it's saved me a lot of money. So by virtue of saving me a lot of money, it's made me a lot of money, is that the throughput on a tons per day basis for an underground mine should be about 40 or 50% of your tons per vertical foot. And and it's easy to actually figure that out, because if you look at a company's presentation, they usually have a schematic of the ore body. And if you just look at where the ore body starts and where it ends, and say, if that's 200 meters, you convert it to feet, and you divide the tons by the feet, and that's your tons per vertical foot. and it's not exact, but that's a pretty good approximation. And if you multiply that number by 40 or 45%, you should get a feel for what type of tons per day that mine will produce. And early on in my career, I found myself way over my head. I was hired to go and do due diligence on a project in Val-d'Or. And, I wasn't yet ready to do this due diligence, but I did as good a job as I could. And the winning question was, while I was going through all the cross sections and I'd gone underground, I looked at everything, and I looked at everything, and finally I looked at it, and I looked at the guy, and I was doing the math as I went. I said, my problem is you only have about 1,000 tons per vertical foot, which means you should be mining this at between 400 and 500 tons a day. But you've built 1,000 ton per day mill. How are you going to produce enough ore to feed that mill? And the geologist at the time looked down. He wouldn't make eye contact with me. And he looked down at the ground and he said, that decision was made in Toronto. And even though I wasn't qualified to do the work, I had done my job. And I got the answer right. I knew what to do. I was on the next flight out of there, and I told them to avoid the stock, and that company later went bankrupt. But that little ratio, which anybody can do, and you don't need a technical degree to do it, has saved me a lot of money in my career. So I don't know if there's